Good morning. Hope you're all well. Warm greetings from the KPMG team in Oman. I'm Ashok Hariharan. I lead the tax practice in Oman. I will moderate today's webinar on the real estate sector. Before I continue, let's look at some administrative matters. You may key questions through the Q&A tab, which will be seen only by the panelists. You can also send your questions through the normal chat box, which everybody can view. We'll address these questions during the Q&A session. Please do not wait for the presentation to end to post your questions. After the webinar, please take a minute to complete the feedback survey. Your comments will always be appreciated. As is the practice, this session is being recorded. The VAT go live date of 16th April 2021 is less than a month away. Authority issued the much awaited executive regulations in Arabic on 14th March. We'll keep you updated on these regulations through our news alerts. We have had so far 5 very interactive seminars in the last 10 days, focusing on the manufacturing, retail, transport and logistics, hospitality and healthcare sectors. After today's real estate webinar, we'll be having one tomorrow for the oil and gas sector, followed by the power and utilities and financial services sectors in the following week. Let's look at the agenda for this webinar, which we expect will take about an hour. After my introduction, we will provide you with a status update on the VAT implementation. We'll take you through the Oman VAT framework and then deal with issues specific to the real estate. Some of these would include the implications of VAT exemption for residential property. How do you deal with mixed use of buildings? What happens if there is a change of use? What is bare land? What are the services connected with land? How do you deal with reimbursement? What happens if rent is not paid? How do you recover input VAT on maintenance of common areas? How do you treat agents? Apart from understanding VAT issues, you also need to make sure that your IT systems understand the VAT requirements. What changes you need to incorporate in your ERP to not only deal with the day-to-day transactions, including issuing VAT compliant invoices, but equally important to generate reports that would be required for reporting to the tax authority. After the IT considerations, we will identify the next steps for you to be ready for the VAT go live date. I'm sure you will get there, as did businesses in Saudi Arabia, UAE and Bahrain, despite many challenges. However, please remember that the go live date is not the sole objective. You need to be confident that your VAT implementation stands scrutiny later by the tax authority. And for this, you need strong advisors who can help you engage with the tax authority. You would also need to take into consideration new clarifications and guidelines which are bound to be issued as both businesses and the tax authority settle into the new VAT era. We continue to be engaged with the tax authority for our clients' benefit. In order to take you through all these topics, we have a distinguished panel of VAT specialists. We have Abba, who hopefully is a familiar face, having been in Oman for the last 3 years. She is now a partner in our tax practice. She has not only helped us establish a strong indirect tax practice to complement our well-recognized corporate tax practice, but has also been playing an important role in sharing insights on VAT to businesses and the tax authority. In the GCC states and in India. We are supported in Oman by Dermot, a very experienced retired KPMG partner. We are fortunate to be able to get his vast experience across sectors and countries, including the UK, Australia, South Africa, and the UAE. Last but not the least, we have Julie, who is not only a VAT specialist, but more importantly, a tax technology specialist. She has been helping a number of Omani businesses upgrade their ERP systems to deal with the Oman VAT legislation. I will now request Abba to give the VAT status update and take us through the Oman VAT framework.
Thanks, Ashok. So the VAT law was published on the 18th of October 2020, takes effect 180 days from the date it was published, which is why Oman is introducing VAT from the 16th of April 2021. In January this year, the tax authority has issued 3 decisions, 2 of which are on registration and 1 on zero rating of certain food items. The decisions on registration, one of them sets out the monetary threshold for mandatory and voluntary registrations. So mandatory registrations for businesses with supplies in excess of 38,500 Omani Riyals per annum, and voluntary registrations for businesses with supplies or expenses in excess of 19,250 Omani Riyals per annum. The other decision on registration provides for staggering the registration as well as go live. So that's quite similar to Bahrain, but the monetary threshold that has been set out is different in Oman. Businesses with annual supplies in excess of 1 million Omani Riyals must register with effect from 16th April 2021, and smaller businesses can then follow. The next tranche going live on the 1st of July 2021, followed by 1st October 2021, and the last on 1st April 2022. Businesses that are eligible for voluntary registrations may apply at any point in time. The process that has been set out for registration of resident businesses with commercial registrations, resident businesses without commercial registrations, and non-resident businesses is different. The monetary threshold does not apply for non-resident businesses liable for registration in Oman. The tax authority opened the registration portal on the 1st of February, and businesses that were required to obtain registration in the first tranche were expected to do so by the 15th of March. Based on the discussions that we've had with the tax authority, we know that they have kept the registration portal open, and at the moment they are considering not imposing penalties on businesses that did not register by the 15th of March. They are allowing them to register without imposing penalties. The portal also allows registration of tax groups, but in order to create a tax group, all members of the tax group must first be registered independently. Now, while the law sets out the framework, as I say, the devil lies in the detail. And the detail on several substantive and procedural aspects are set out in the regulations that were issued in Arabic on Sunday. The unofficial English translation of the regulations from the tax authority is currently awaited. The tax authority is also working on general and sector-specific guides that will allow businesses better visibility, and those are also expected to be issued in due course. At the moment, there is also some clarity which is expected on some of the processes for notifying the tax authority on certain items or requesting their approval on certain arrangements. For instance, deferral of import VAT, simplified billing arrangements, exemption from registration, availing pre-registration input tax credit, which will be critical given that we have staggered implementation. So we're expecting that some guidance will be put out by the tax authority in due course and hopefully before go live. And all of this happens for the go live that's scheduled on the 16th of April. So let's see how VAT will operate once we go live on the 16th of April. How does the Oman VAT framework work? Now, first, what is VAT? VAT, as the name goes, is value added tax. It is a tax that is imposed on the value added in each stage of the supply chain. The supply could be of goods, supply could be of services. As an indirect tax, this is intended to be borne by the final consumer, that's you and me. The business is just acting as an intermediary, collecting and depositing the tax on behalf of the tax authority and the customer. It's not supposed to be a cost to business, but in certain circumstances where the sector or the supply is exempt, this could become a cost to the business, in which case you need to look at your commercial or pricing decisions to see how you can or would want to pass this on to your customers. VAT globally is also known as goods and services tax. It originates in the 1950s in Europe as a substitute for a lot of retail sales taxes that existed at the time. In the world so far, we have 169 countries which have already implemented VAT or GST. The concept is fairly new to the region. We had KSA and UAE implement VAT from the 1st of January 2018, Bahrain from the 1st of January 2019, and Oman is the first country to have implemented VAT in the region. Now, let's look at a few concepts which are critical to any discussion around VAT. Presuming that 30 days ahead of implementation, you are familiar with most of these concepts. We won't get into the details. We'll just touch upon them so that you're able to appreciate the issues that Dermot will discuss later a little better. So on the next slide, we can see some of the concepts which are important to VAT. Supply is important because eventually VAT is a tax on supply of goods or services. In certain circumstances, even when the essentials of a supply are missing, a transaction may deem to be a supply for VAT purposes and may create a VAT exposure for the business. This is what we commonly refer to as deemed supplies, and we'll deal with such instances in a couple of slides. Time of supply is important so that a business understands when their obligation to pay VAT arises. And this could differ depending on what kind of arrangements you are in or what kind of supply you're making. Place of supply is important for you to understand which country has the jurisdiction to tax a particular transaction. Value of supply is important for the business to understand what is the tax base on which VAT should be paid. It is, of course, the monetary consideration, but in certain circumstances, non-monetary consideration could also get added to the tax base. You also have the provision to make certain deductions or exclusions from your tax base, discounts, grants, but you need to look at the conditions which are attached for the deduction. In case of related party transactions, you need to make sure that the transactions are at fair market value. And there is a mechanism which is set out to determine how you arrive on the fair market value. Reverse charge is equally important a concept to understand. As the name suggests, it's the charge being reversed. So technically, the liability or the obligation to charge VAT is that of the supplier. But in certain circumstances, the charge is reversed. Instead of the supplier discharging these obligations, the recipient does. Typically, this happens in the case of import of goods, import of services. When you're purchasing goods or services from an overseas non-resident business that is not registered for VAT purposes in Oman. So as the registered business that is importing the goods or services in Oman, the obligations to discharge as well as report VAT on such transactions is on your business. Input tax is extremely important to the entire functioning of the VAT regime because, as I mentioned earlier, it is value-added tax. In order to make sure that you pay tax only on the value that is added, it's critical that you are able to recover the VAT that you incur on purchases. And that mechanism is the input tax mechanism. We'll deal with that in just a bit before we go on to the compliance obligations. So on the next slide now, let's look at the important types of supplies. We've got taxable supplies that include standard rated supplies and zero rated supplies. And then there are exempt supplies. There are other types of supplies too, which are VAT suspended supplies or out of scope supplies. But it's important to understand these three types before we move on to the variations. If we look at standard rated supplies or zero rated supplies, the supplier is required to charge a VAT. The rate of tax will depend on the nature of the supply. In case of standard rated supplies, it's the standard rate, which in Oman is expected to be 5% initially. In case of zero rated supplies, it's 0%. But because there is a charge of VAT on the supply, the supplier is eligible to recover the VAT that they incur on the purchase of goods as well as purchase of services used to make these supplies. So it's not a cost to the business. But if you look at exempt supplies, the supply, as the name goes, is exempt. So the supplier does not charge a VAT, but because there is an exemption, the supplier is also not eligible to recover any input VAT incurred on the purchases used to make that supply. Now, these are concepts which will be critical to the real estate industry because when we look at the exemptions, the concessions, you will see that some of the exemptions, such as supply of bare land, supply of residential properties, may be exempt. And you may have instances where supplies of residential properties, supplies of commercial properties in certain circumstances could be standard rated. So it's important to understand the type of supply and your tax obligation. So on the next slide, let's look at how Oman VAT law treats certain sectors. What's important for us, as I said, is the exemptions. If you see, Oman VAT law exempts the supply of bare land. But what constitutes bare land in common parlance may not necessarily apply to VAT interpretations also. And Dermot will deal with that in greater detail later. Similarly, an exemption is also provided for resale of residential properties or lease of residential properties. So that implies that the supply, the first supply of a residential property would be standard rated. There are zero ratings which are set out for supplies that you make within Oman, make outside Oman, but they may be of limited relevance to this sector. They are on the slide just in case you want to go through them. As I mentioned earlier, there's also some other variations to this type of supplies, that's suspensions and out of scope. Suspensions essentially apply when there is a custom suspension on the import of goods. The VAT on these is suspended too. Similarly, when you make supplies to, from, or within special economic zones, they are eligible for a VAT suspension, which is akin to a zero rating. So far as out of scope transactions are concerned, these, even if they have the essentials of a supply for VAT purposes, are treated as outside the scope of VAT. These may be because the place of supply is not in Oman, or it is a transfer of business on a going concern basis, or even supplies made within members of the same tax group. In such instances, you do not charge a VAT on the transaction, but that does create a question on your ability to recover the input VAT that you incur on the purchases used to make such transactions work. On the next slide, let's look at what deemed supplies are. Now, the basic premise for deemed supplies is that the supplier must have recovered input VAT on the goods or services that are used to make such a supply. What are the common examples of deemed supplies? Supply of goods or services without consideration. So let's say you have schemes where you give a month of rent-free accommodation. Would that qualify as a deemed supply? Or instances where you purchase goods or services with the intention of applying them for taxable supplies, but use them to make non-taxable supplies. Or you purchase them with the intention of using them for business, but do not eventually use it for business. In these instances, you may either need to look at having to charge VAT on the supply or not recovering the VAT that you incur on the purchase of goods or services used to make these supplies. If we move on to the next slide, we can then deal with the time of supply. The time of supply, as I mentioned, is important because it helps you ascertain the time when your obligation to pay VAT arises. If you delay the payment of VAT from when it's due, you could be exposing yourself to additional tax and penalties from the tax authority. Now, the general rule is that the time of supply is the earliest of the date of supply, the date of issuance of tax invoice, or the date of receipt of payment. So in instances where you receive advances, you could be exposing yourself to a VAT liability before you're even making the supply. And it will be important, and we can look at this later when we are looking at transitional contracts. If you've recovered any advances for supplies that you will be making on or after the 16th of April, how do you deal with these tax obligations on the advances? There are special rules for continuous supplies where you have an arrangement for making periodic invoices or receiving periodic payments. And in such cases, the time of supply is the earliest of the date of payment specified in the invoice or the date of actual receipt of payment. If we move on to the next slide, we can then look at the place of supply rules. The place of supply rules, as I mentioned earlier, help you decide which jurisdiction has the right to tax a particular transaction. There are special rules for supply of goods, supply of oil and gas and water, and supply of services. And then there's special instances which are set out under a different place of supply rule. What is most relevant for businesses in the real estate sector would be the special cases where services related to real estate are deemed to have been supplied where the real estate is located. If we move on to the next slide, we then deal with the input tax recovery mechanism. As I mentioned earlier, it's important to understand the input tax recovery because this is essential to the entire system of value added tax. Uh, According to the Oman VAT legislation, a business is allowed to recover input VAT paid on goods or services that are used or intended to be used for taxable supplies, which is standard rated supplies or zero rated supplies, and exempt supplies when rendered outside Oman. In order for you to avail input tax credit, you need to be registered, you need to have a valid tax invoice, and you need to comply with the basic input tax recovery rules. You have up to 3 years from the end of the tax period in which the right to deduct input tax arises to recover the input tax. In certain circumstances, input tax is allowed on goods which are lost, stolen, damaged, or given away as commercial samples or gifts. But these come with conditions attached. In case of commercial samples, this can only be of up to a certain monetary value. Certain expenses, even if you incur them for the purposes of business, may not qualify for input tax recovery. Under the Oman VAT legislation, these essentially are entertainment expenses, and unfortunately, the scope of entertainment has not been defined. Expenses which are in relation to motor vehicles that are available for private use, and food and beverage or catering expenses. In certain circumstances, you may have to adjust the input VAT that you have recovered. Typically, these would be instances where your supplier gives you a post-sales discount and is looking at adjusting their VAT liability, or there could be bad debt adjustments. Now, what's important for this sector also is how the input tax recovery mechanism works when you make taxable as well as exempt supplies. And in these circumstances, you will need to apply an apportionment method. What that means is when you make purchases, purchase of goods or purchase of services, which are directly attributable for making taxable supplies, you will be eligible for full input tax credit. When the purchases are directly attributable to exempt supplies, you will not be eligible to recover input tax credit. For common expenses, you will be eligible to recover input VAT only in the ratio of your taxable turnover to your total turnover. Now, given that Oman is implementing VAT on a staggered basis, some businesses may be registered on the 16th of April and some may be registered at a later point in time. So the Oman VAT legislation does make provisions for a business to recover input tax on expenses incurred before registering for VAT purposes. But these come with conditions attached, and these are separate for goods and separate for services. If we move on to the next slide, now look at the compliance obligations that businesses need to fulfill. For every supply that you make, you need to issue a tax invoice, and the contents that need to go on a tax invoice are mentioned in the legislation. You can, in certain circumstances, issue a simplified tax invoice, which has lesser details, but you need to do that only after approved by the tax authority. You can also issue invoices in foreign exchange, but they need to have certain additional details and the value in Omani riyals, which is based on the conversion rate issued by the Central Bank of Oman. And invoices would need to be retained or documents would need to be retained in case of real estate transactions for 15 years and in other circumstances for 10 years. Returns initially will be on a quarterly basis. The return for the period starting 16th of April to the 30th of June would be due on the 30th of July. At a later point in time, we expect that the tax authority may allow different tax periods, monthly instead of quarterly, or the taxpayer may be allowed to request a change in tax period. But at this point in time, everyone is on quarterly returns. and you have the right to revise your returns up to 3 years from the date they are submitted. The provisions also allow for refunds in certain circumstances, but that will be by way of a different process. You will have to file a refund application, and that would be required to that is required to be filed within a certain number of years of your right arising. So that's an overview of how the Oman VAT framework looks. With that, I'll pass this on to Dermot and ask him to take us through some of the issues which are peculiar to the real estate sector in Oman. Dermot, over to you.
Thank you, Abba. And should I wish everybody on the call a happy St. Patrick's Day, today being Ireland's National Day. Property sector, or real estate sector, does give rise to a number of complexities from a VAT perspective, and can trap the unwary. So it is important to look at your transactions and be sure that you've met the VAT requirements exactly. A basic principle in VAT law is that an exemption from VAT is an exception to the standard rule, and therefore it has to be narrowly interpreted. So when looking at the legislation, you have to take it exactly as it's written and see, does it apply to you. The more important ones, as Abba has mentioned, are a VAT exemption on residential property. That applies for the resale of residential property, or the rental of properties for residential purposes. And the recently released executive regulations define residential real estate as any building or part thereof designed or prepared for residential purposes, and obtain the approvals from the competent authority in that regard. It also, however, lists things that are excluded from residential real estate, and they include any building that's used as a hotel or a tourist complex, an industrial complex, or a place providing accommodation and breakfast, or a hospital or similar buildings. It also excludes any hotel apartments and any structure that's not fixed to the ground that can be moved without damage. So there are exclusions from the definition, but if you've got a resale of residential property or a rental of residential property, you have a VAT exempt activity. It can be tricky when, because of market conditions, a developer who has constructed new residential property makes a decision because he can't get enough sales to make a short-term letting. He's created a lease, and therefore he has supplied the residential property, and that income is exempt. That may cause a clawback or a reduction of his input tax credits that he claimed when he constructed the building with the intentions of selling it as new, unused property. So that can be a tricky one. Another tricky area is the definition of bare land. And bare land in the legislation, and I'm just going to call it up as I'm talking to you so I can read it to you exactly. Bare land has a definition of any land that doesn't have any construction or property on it or under it in the subsoil. However, there can be difficulties in relation to bare land of when somebody has provided services to a site, for example, has laid in the infrastructure, roadways and pathways, power, water, sewerage, etc., can all be provided to a site, and then the individual plots of land are sold off, where the purchaser can build their own construction on the site. You have to look at that very carefully and determine, is it still bare land, because you have made available all of the facilities that would allow the construction of a property on it, and it's not just pure land. Another tricky area is on mixed use buildings and the consequences of a change of use. So you can have a building that has commercial units on the ground floor, for example, shops or offices, and then may have residential apartments up above. Commercial property is going to be standard rated, be it rental or sale, whereas what we saw already, the rental of residential property is exempt. And that will cause, as Ava mentioned, the need for a partial exemption calculation to restrict input tax on the residential part and claim it on the commercial part. It can also be tricky where you have a change of use or a change of intended use. A building may be constructed initially as with the intention of it being a commercial property and the VAT recovered, but subsequently a decision is taken to change its use and make it into residential property for letting. That will require a revisit of the original intention and a revisit of the input tax that was claimed. Landlords often struggle, or property management companies often struggle with the concept of disbursements and the recoupment of disbursements from tenants. The basic principle in VAT legislation is that you can only recover VAT on goods or services that were supplied to you. If the services were provided to the tenant, but merely paid by the management company or the landlord, and then passed on to the tenant, the argument will be that that's a disbursement. The gross amount is passed on, and the input tax shouldn't be claimed by the management company or the landlord because the service wasn't provided to them. However, in some instances, the management company may bundle a number of activities in terms of costs of managing a property, add a handling charge or a profit margin, and pass it on to the tenants as a fixed monthly charge. In that case, they are actually providing an onward service and the input tax would be claimable. So it's important to look at the terms and conditions of the letting, the leases, etc., and what are the actual costs being incurred to understand whether you have an entitlement to claim the tax on it or not. Another area we often get asked about is the question of security deposits, where we require a tenant to lodge an amount of money at the onset of a lease to be held as a security deposit. That deposit is refundable to the tenant if the property is handed back in an acceptable condition at the end of the leasing period. Now, deposits are not supplies in their own right when they are purely deposits and are genuinely refundable. But in the real estate sector, as often happens, security deposits can be converted into the final month's rent, or they can be not refunded because of damage to the property, etc., non-payment of utilities, etc. So again, you need to look carefully at the time of supply for VAT purposes and whether the security deposit is genuinely refundable or is going to be offset against other services. And remember that if it is offset, you've created a tax liability and you have to account for VAT, even though you may not be issuing an invoice because you already have the funds. Non-payment of rent, obviously the question there is it genuinely a bad debt, and can you make an adjustment at the for the VAT, that if VAT was charged on commercial property, can you make an adjustment for the VAT that was previously charged and just not paid or not collected from the tenant? Add-on services in relation to common areas can often be a tricky one as well, where you have a complex which has common gardens or courtyards or parking areas or whatever that the landlord agrees to maintain over the life of the property. And the question then is the landlord entitled to recover the input tax in relation to those maintenance of common areas? And again, it will come down to looking at the nature of the leases and the nature of or sales if the properties were sold, as to see, did the obligation arise at the time, and is it genuinely a business expense, or is it an expense in relation to a supply that has been made in the past and may not be recoverable. So again, it is and can be a tricky area. Have I mentioned that the legislation provides a place of supply for services connected with land, and the executive regulations give us a definition of services connected with land. So the basic definition is that they are services which affect the area of the real estate or are related to a specific area of real estate. The regulations give us a list for which is not intended to be exhaustive, but is indicative to help us understand what that means. And they say that real estate services include engineering, management and construction, supervision of works, studies, a generic term not defined, studies, residential services in itself not defined. But more importantly, and these can be where some of the tricky areas arise in the real estate world, is the granting of any right over real estate, assigning it or leaving it, or the granting of any right to claim any right over real estate. So typically examples would be where somebody has an option to purchase land, decides maybe not to go ahead with that, but passes on that option to another person or sells it for a consideration. That is a supply of a service connected with real estate. The granting of any right to obtain a right over real estate, or the granting of a license to occupy real estate, assigning or leaving the license, are also supplies of services connected with land. Building or demolition services and services related to the executing of construction works. And the works of trading buildings, management of buildings, maintenance and repair works of buildings, real estate agents and brokers are all services connected with land. And as I mentioned earlier, the place of supply in those instances is where the land is located. If the land is in the Sultanate, then they will be taxable in Oman, regardless of the place of residence of the supplier. The treatment of agents, a common issue in the real estate world, where somebody uses an agent to either let the properties in the first place or to manage that letting going forward. The VAT regulations require that the agents must be formally appointed. They must submit to the tax authority the power of attorney of their appointment. But agents are acting for and on behalf of and in the name of the principal. So the agent is only liable to VAT on the commission that it charges the principal. The basic liability still remains with the principal. We have seen in some jurisdictions a practice where there are separate but conditional contracts for land and construction. In other words, I'm maybe building a large development, for example, at or around an amenity like a golf course, and I decide that I'm going to sell the individual sites for properties at that development, but I'm also going to sell them subject to a conditional contract that I am engaged to construct the building on that land. If you have a conditional contract, you could be in danger here of getting into the area where something that would have been bare land is now something else because of the conditional contract for construction attached to it. So again, a tricky one. Watch the terms and conditions of the contracts and how they're worded. Compulsory purchases, these will arise where the state may want to acquire land or property for civil engineering work, such as road building or bridges or whatever, and they exercise their right of compulsory purchase. The VAT legislation includes compulsory purchase as a supply. So you are making supply even if you did so involuntarily, and you have to account for VAT. Compensation for early termination, what we mean by that is where a landlord might induce somebody to exit a lease early because they want to redevelop the property, for example, or they have a different or newer tenant who wants to take on a bigger section of the property. That is a question then arises, is that a supply by the tenant to the landlord? And is that a taxable supply? And the question you would have to look at is that the business of the tenant, or is it a one-off transaction? So again, the terms and conditions and the nature of the parties involved will be important to look at, see whether that compensation should be taxed or not. And excuse me, similarly, tenants' improvements and compensation for damages. Tenants' improvements will be where by what the words mean, the tenant actually improves the property over the life of a lease. Is that then a separate supply back to the landlord, albeit akin to a barter transaction, where the tenant makes the improvement to the property and may do so in return for a rent-free period or a reduction in rent. And you have to look at the individual transactions and assess the VAT treatment of them separately in order to arrive at the right answer for tax, even though the commercial reality is maybe different. And as I mentioned earlier about compensation for damages, which is the thing which can arise, as I say, often when you're dealing with the refund of security deposits. Is looking at, is that compensatory damage a taxable supply, or is it akin to a damage that might be awarded by a court and therefore not a supply? Again, looking at the facts and circumstances around each individual transaction would be important. So I think you'll see that in the real estate sector, there are a number of complexities. There are pitfalls for the unwary. And given that these are generally large ticket items, even at 5%, the VAT can bite hard if you get it wrong. So it's important that you manage your exposures properly and you look at all the transactions in detail. So with that, I'm going to hand over to Julie, who's going to talk to us about technology required. Thank you.
Thank you, Dermot. As Dermot mentioned, to manage your volume of transactions and make sure that you address all of the complexity of the transactions that real estate is into, it's important that you have an IT landscape that actually supports you in the VAT compliance. So this slide represents all of the different VAT touch points that you typically have in your IT landscape. I will not go through all of them, but I will try to, in the next 10 minutes, to point out the main ones that you need to address and that will be essential for you to look at to ensure that you are ready for the VAT implementation in 1 month's time. So in order to be able to decide whether you need to apply VAT or not, it is important to ensure that each of the different service types that you have in your system get correct VAT treatment. So you need to distinguish in your systems in terms of your master data whether a service type is taxable, exempt, and how are you going to treat it when you issue an invoice to the customer. Also, you need to make sure that you distinguish between different customers, whether the customers themselves are individuals or other businesses. Similarly, on your vendor side, you also want to know whether the vendor is already registered for VAT or not, especially given the fact that Oman will be using the so-called staggered registration process. You want to be able to know when you receive an invoice from your vendor, whether they have applied VAT correctly or not. So you might have already noticed that companies are already exchanging their tax registration numbers between themselves and informing their suppliers and customers that they have been registered and what their number is. It is important to capture that in your ERP systems to have a trigger for the system to know if you receive an invoice from a vendor that is registered, then VAT is applied correctly. If you receive an invoice with VAT and you don't have that tax registration number, that should be a trigger for you to say, I need to verify whether this vendor is truly registered and whether they're supposed to charge me VAT. So once you have those mandatory elements addressed in the system and you have the indications whether something is taxable, something is exempt, that should help you manage your invoicing process, because invoice is a very important document in VAT terms. And therefore, you need to make sure that all of the invoice templates that you have in your systems, that they are updated to be correct tax invoices. But given that real estate sector is partially into exempt and partially into taxable supplies, you will need to make sure that you reflect transactions correctly, and you have correct invoice templates to address exempt and taxable transactions. So in order to make sure that whatever you have applied on your taxing on your invoice, and also that you capture the VAT that is charged to you by the suppliers, what you also need to have in your system is indicators of different treatments of transactions. So the so-called tax determination logic is typically defined in the ERP systems by so-called tax codes. So in order to have a granular reporting that will help you populate the tax return, you need to have tax codes defined in the system, and our recommendation is typically to define as many tax codes as different transactions that you are involved in, to have all the different variations, because the fact is we don't have the Oman VAT return template yet. And if we look back at the implementation in UAE and KSA and Bahrain, then typically the VAT return form is being published by the authorities only, say, 1 month before the filing due date, which will be likely, probably, I bet, on June. If it's earlier, then we're lucky. But in any case, you will be setting up your systems now, and you shouldn't be waiting until June, because you want to issue your invoices now. You want to have the tax codes already in the system. So what our recommendation is, define as many tax codes as possible variations of tax treatments that are defined in the law. So do have 5%, zero rated, exempt, have it all in your system so that you have all the possibilities. On the purchasing side, you can have maybe recharges from your sister companies from abroad. You can have charges from maybe consultants from another country. So make sure that you have reverse charge in your system, that you have also taxable zero rated on the purchasing side, so that you have a clear distinction, because that will define how do you populate your tax return in the future. And all of that will, it is easier to have more tax codes that you put in one box of the VAT return, rather than having only one tax code that has multiple types of transactions in it, and that you would need to segregate it for the reporting purposes. That would be much more complex to deal with, rather than now, once you're implementing the system, to define multiple tax codes from the start. So there are a lot of things to look at and to address, and now is the time to define the system in such a way that you are ready to be compliant from the first day of the implementation. So have a holistic view at your systems and make sure that they are ready to assist you in being compliant with the VAT regulations. So with that, I give it back to Ava to discuss the next steps.
Thank you, Julie. So I think the messaging is very consistent and clear that VAT impacts all facets of business. It's not just a tax or a finance project, it's a business transformation project. If you look at the next slide, it gives you a snapshot of how different functions are impacted, the action points for you to look at under each of these functions, the impact it's going to have on your ways of working. With less than 1 month to go, it's important that you prioritize and focus on mission critical items. On the next slide, thank you. On the next slide, we've put together mission critical items that you need to certainly look at between now and go live. You need to understand your registration obligations, know the registration options, whether you want to register independently, whether you want to register as a VAT group. If you're not required to register at this point in time, would a voluntary registration help you in terms of tax efficiencies? Weighs your pros and cons before you register, and register in time. VAT is a transaction tax. It's important that you look at the different types of supplies you have, the purchases that you have, and ascertain the tax implications at a transaction level. And if you're eligible for any exceptions, then apply for those exceptions. See whether you are eligible for those exceptions automatically or whether there is an application process, and those details are set out in the executive regulations. Review your contracts. VAT is not intended to be a cost on business, but in the absence of a VAT recovery clause, you could end up paying VAT out of your own pockets. So you need to make sure that your contracts are reviewed to have the right VAT recovery clauses. Understand the impact VAT is going to have on your IT systems. Make sure that you configure and test them in time, and plan a cutover strategy. Transitioning to VAT generally can be complicated, and to have to do that in the middle of the month is even more complicated. So just make sure you have a cutover or a transition plan, and make sure that your staff, your team is upskilled, because in order to ensure VAT compliance internally, in order to make sure that you communicate your VAT obligations to your customers as well as vendors, right? Your team needs to understand the VAT obligations well. And finally, go live. But that's just the beginning. That's not the end, because even after the 16th of April, you will see clarifications come out from the tax authority. You may have to reassess your tax positions. You may have to revisit your system configurations. So you need to make sure that you stay agile. With that, we can close the presentation for today and move to Q&A. Thank you, everyone.
Thank you, Abba, and the panel speakers. So yes, there are quite a few questions coming in from the attendees. I will post the first question to Julie. I have received a letter from my landlord that they are evaluating the levy of 5% on the rent for my villa. Will the rent for my villa go up by 5%?
Well, that basically depends whether that villa is residential, or maybe it is a combination of a commercial and residential villa. Because if it is a so-called combined commercial villa, then the landlord may increase it by 5%. So that will need to be seen for your particular circumstance. And obviously, if the so you also need to look back at your initial contract and see whether there is a possibility for the landlord to increase the price while contract is ongoing. So there are quite a few things to look at in this specific situation. It's not a clear-cut answer.
Yeah, Julie, what if the villa is used only for residence, not for commercial, and
So
the
if
landlord wants to charge 5%?
The pure residential property should be exempt, and therefore
Right.
there is no reason to charge that 5%. Exempt is exempt.
Exactly.
What you may
Okay.
need to look at in that case is that, as Julie said, does your contract allow for a price increase? So
Yeah.
what will happen is that your landlord may incur certain expenses towards upkeep of the villa, and any VAT that they incur on these will become a cost to their business, which they may then look at passing on to you by way of increasing your rent, and you'll need to then go back to the contract to see whether they can increase the rent or not.
Yeah. Thanks, Abba. Next question for Dermot. Is VAT applicable on rental agreements made in company name and used for accommodation to employees? Also, if one or more flats are used for providing food to staff accommodated in that building, what is the VAT implication?
Okay. Thanks, Ashok. So the definition of residential property is a building or part of a building that's designed and prepared for residential purposes and obtained and is approved by the competent authority. So the rental or letting of a residential property is VAT exempt. The question as to who pays the rent is not material in this example. We understand from, or my understanding of the question you're asking is if the employer is paying the rent, does it change the nature in effect of the letting? And my answer to that would be no. You'd have to look at the question then about separately about the flat that or the unit that may be used as a dining room or facility for providing food. Does that then fall outside their definition of residential in relation to that part of the building? So it will be down to the facts and circumstances around the each individual case that you would have to look at it.
Right. A slightly different question from the same person. What will be the VAT treatment in case of accommodation hired by company for staff of client, and the same is being invoiced to client for reimbursement on actual rent basis?
Ava, do you want to look at that? That's effectively, as I understand it, it's like entertainment. It's the staff of a client. It's not your staff.
No, it may be, I suspect, I don't know the background,
Okay.
but I suspect, they are providing accommodation to contractors or subcontractors who may be engaged by the company, and the requirement is that they arrange for the accommodation, but the rental cost is charged to the contractor. That's what I'm guessing. Abba, any thoughts?
Sure. So I think what we need to look at is whether the premise that we are talking about qualifies as a residential property or qualifies as a serviced apartment. If it qualifies as a residential property, then the landlord, when he's charging the first company, will not charge a VAT, it will be exempt. And when you're passing this on to your customer, you would need to look at the terms of your contract on whether you are recharging this as a part of the consideration that is incidental to the main service or the main goods that you're supplying to the customer, or whether this is just a reimbursement or disbursements which is in the nature of rent, and accordingly decide the tax treatment. If it's of course treated as a serviced apartment, then the landlord will charge a 5% VAT, and the question then would be whether you are eligible to recover the VAT or not, whether depending on how you're on charging this to your customer.
Right. Thank you. Question to you, Abba. Is an individual renting multiple properties required to register for VAT?
So we have seen a lot of instances where individuals own properties. These are rented for residential as well as commercial purposes. In the past, they may or may not have obtained registration for corporate tax purposes. When you're looking at VAT, you need to assess your VAT obligations independent of your corporate tax obligations. And what you would want to look at is, are you in the activity of renting out these premises, and whether that activity is carried out on a continuous basis or a regular basis or not. What is the turnover that you make from these supplies, whether that exposes you to a registration obligation. So for instance, if you're renting only residential properties, even if you make in excess of 38,500, this is likely to be exempt from tax, which means you may not be exposed to a registration obligation. But at the same time, if you're making commercial supplies or renting out commercial places, then these may be standard rated. If they are in excess of 38,500, then even though you're doing this in individual capacity, you may be exposing yourself to a registration obligation, and therefore all the other obligations such as charging VAT, issuing invoices, filing returns that ensue.
Julie, can you take this question? What if we adjust pre-VAT rent in the rent recovered for the period after 16th April? Can we reduce it from our taxable value?
Okay, let me see if I understand the question correctly. Basically, that has to do with the transitional provisions and whether you should be collecting VAT on the rent after 16th of April, to which the answer is yes. But I think the second part of this question is, do we necessarily need to charge it to the client, or can we charge it, or do we need to pay it from our own pockets? That's how I understand it. And basically, again, you need to go back to your contract and see, is there a provision that allows you to, for example, a change in law or a VAT clause in your existing contract? If that allows you to increase the rent by that tax amount, then yes, you would be able to pass it on to your customer. If you don't have any provisions, then actually the law says that any amounts agreed are inclusive of tax, and therefore you would need to consider whatever money that you have received as inclusive of tax. And if it's taxable, then VAT will be coming out of that amount.
I understood the question slightly differently. I thought
possibly, as I said, I wasn't sure.
It is a broad question. The way I understood it is that if I have a rental obligation, let's say after 16th of April, and I have it from the same landlord, but the landlord is adjusting the rent for a prior period from the rents pertaining to the period after 16th of April, whether that can be reduced from the taxable value or not. And to that, if that is the question, then my answer would be, you would have to look at the adjustments to consideration prior to 16th of April differently from adjustments to consideration after 16th of April. So you can't adjust a rent for a prior period from your taxable value after 16th of April and reduce your VAT liability. If that is the question, that is.
Okay, I think we have two interpretations to the question, and we have answers for both. Great. Dermot, if you could address this question. We have some dues from customers. We have completed the work orders in 2020, but the amounts are outstanding. If we receive these payments after 16th April, do we need to pay VAT on it?
Okay, so again, just to say on the basis of my understanding of the question is, the service has already been provided going back some time and is finished, and all that remains open is the question of payment. So if the service was completed before the introduction of VAT, i.e. before the 16th of April 2021, it doesn't have any VAT on it, even if it's paid after that date. So the mere collection of the debt doesn't bring it in the charge of VAT. What you have to watch for, though, is if it's a continuous supply of services, and when the where a service is being carried out on a continual basis, when the tax point arises. That's not my understanding of the question. My understanding is the service had already been completed, and it was just a matter of collection.
Yeah, yeah. And then that question about sort of whether the activity is continuing, even if one particular contract is completed, I guess is important to decide on whether that company needs to be registered for VAT.
Yes, yeah, you need to look at those. But if you've got a continuous supply that straddles the implementation date, just making a payment before the implementation date doesn't get it out of the VAT net. It's the question of when is the service actually supplied, and the law has particular provisions, as Haba mentioned in her presentation, about the time of supply for VAT purposes. And so just be careful on the period. If it's a genuine continuous service that straddles both pre and post, then you have to apportion from the bit before the 16th of April won't have VAT, and the bit after 16th of April will.
Yeah. Okay. Last question for Abba. We have a group company that manages our facilities. Currently, they do not charge us for such services. What is the VAT implication?
So if there is a provision of service, then you do need to assess your VAT obligations. Just because there isn't a consideration attached doesn't mean that there isn't a supply. And especially because these are transactions between group companies, you would need to look at what the fair market value of these transactions would be, benchmark it by the fair market value, and you would have to at least discharge your VAT obligations. You would need to charge a 5% VAT. It is for the receiving company to assess whether they would be eligible to claim input tax credit or not, depending on what kind of property this relates to. One of the practical suggestions that you may want to look at is the possibility of grouping these companies together, and whether that would bring in any efficiencies, because supplies between members of the same tax group are out of scope. So short answer is there would have to be a value, there would have to be a VAT on it. Recipient would need to see whether input tax credit can be availed, but there is an option of grouping to optimize the tax incidence.
Right. Okay, so lots of issues to consider as you get ready for VAT go live. So thank you participants for joining the webinar and posing your questions. And thank you all the panelists for your wonderful presentation and answers to the queries. So we look forward to interacting with you in the future. Thank you. Bye-bye.
Thank you so much. Have a good day. Bye.